Hello and welcome back from the long weekend and to the Market Lens. I'm Sam Rozzi, manager of Due Diligence, and I'm joined by Cliff Walsh, our chief investment officer. Please check out our previous episodes available in Studio 454 or on YouTube. Today's News or Noise segment will discuss fund flows. Let's start with emerging markets. We've seen a streak of 2 weeks of outflows in EM equities after a strong period of inflows. Do you believe this is news or noise?
That's a great question. There are always ebbs and flows of investment funds entering and exiting countries, asset classes, and industry groups. They can have a more substantial impact in smaller markets like EM, so they are important to pay attention to. But at this point, I would say that it's noise, just normal fluctuations in asset flows. However, it is something to pay close attention to if you are currently overweight emerging markets, because while 1 or 2 weeks doesn't make a trend, we are sensitive to the possibility of a longer trend starting here, particularly with the US dollar pulling back over the past 14 months and looking like it might be stabilizing not too far from a 5-year low hit in 2018. In high growth scenarios, emerging markets can outperform a strong dollar, but it's typically a solid headwind that you want to avoid. If you are overweight emerging markets, I think it pairs well with being overweight in 10 and 30-year treasuries, which would provide some ballast in a risk-off environment, a time when EM would likely suffer. Not to mention, long-dated treasuries are likely to be a beneficiary of a stronger dollar. They've held up really well with a weaker dollar, but typically when you see currency strength, it's an added kicker to that long-duration trade for foreign buyers. Not only do you get relatively better yields than most other sovereigns, even with those with significantly worse credit ratings, but you get an added performance boost from the currency. So the outflows in EM is noise right now. I think it's too early to call the end of a trend, but it's been a great run in emerging markets, so it deserves a close watch because this could turn into news if we see those outflows continue.
Thank you, Cliff. But let's switch gears away from emerging markets and to the more broad topic of active versus passive flows. Inflows into passive vehicles have been rising for the past few decades now. Last year, we saw $250 billion in asset flows out of active management. Do you believe this is news or noise?
It's news. It's probably not surprising news to anyone, but it's an ongoing trend that will shape the market, so it's important to watch, and that makes it newsworthy. Passive funds held up really well during the volatility of 2020. Active funds need to perform better and lower costs to compete. That being said, there are a lot of active funds that aren't very active. There are closet indexers charging active prices. They're being exposed and losing dollars as they should. True active funds, as measured by high active share, that charge reasonable prices and put up good numbers are always going to be around. Not to mention the more dollars that flow into passive pooled investment products, the more likely there will be a dislocation in individual asset prices, creating greater opportunities for active investing. But the closet indexers are at risk. They continue to underperform by their own doing. They hug the benchmarks and charge higher prices than passive vehicles. There's really no way to beat the market as a so-called active player, and that's what people pay for.
Yeah, thank you for your color, Cliff. It's clear that passive vehicles are here to stay and they're gaining significant flows, but it's always a difficult sales story if your portfolio is 100% constructed of passive ETFs. So let's now zoom into the market lens and discuss ESG investing. Sticking to trends in flows, ESG funds saw inflows of more than $50 billion in 2020, double of what they received in 2019. And clean energy in particular saw extreme outperformance as ICLN, the iShares Clean Energy ETF, was up over 141% in 2020. This ETF has pulled back pretty significantly since the end of last year, but these facts have some concern of a green bubble. Do you believe there is a bubble in ESG assets?
I've always struggled with how ESG flows are classified because there are a lot of funds out there that say they're ESG and invest mainly in the S&P 500. That being said, you're correct. Huge flows into the space. I think there are two drivers there. Millennials perhaps hitting their stride a little in terms of saving for the future. It's always tough to paint with a broad brush, but in study after study, millennials stand out from the crowd in support of ESG and impact investing. Second, you had a change in presidential administration and Senate leadership to the Democratic Party, who have huge ambitions for clean energy and attempts to combat climate change. So I think a lot of these dollars were seeking opportunity. We're watching the flows. So far in 2021, they've continued. Q1 set another record of dollars invested in ESG, beating Q4's record. I'm not sure it's going to slow down anytime soon. So in answering your question, is there a bubble in ESG? There are a few things to consider. Flows, scarcity of investment opportunities, outlook, and valuations.
So now that we've discussed the flows, what do you think about the investment opportunities in the ESG space?
Well, there's a lot of money coming into the space. Are there enough opportunities? In 2020, we saw a 30% increase in sustainable funds offered to the public. So more options are helpful because of diversity of opinion, but really what matters most is the number of companies that can be classified as ESG worthy that receive the actual investment funds. It's impossible to give you that number because many funds not only look at the current ESG characteristics of a company, but also the direction these metrics are headed. There are funds that will invest in an oil company if it makes progress with its environmental record. So I think the ESG space is a lot wider than some people think.
Yeah, I think one problem with the ESG space is everyone has a different opinion of what ESG is. But going back to your previous comments on passive flows, how relatable is that to ESG investing?
Yeah, I would say the same concerns arise in ESG that come out of the ETF marketplace. You have a basket of stocks, whether they're grouped by ESG, an industry group, or a broader passive index. When money flows into that ETF, it does not necessarily take into consideration the valuation and fundamental outlook for each individual company, which can create mispricing situations either in individual stocks or the entire basket.
Okay, so what else should we be considering?
Well, my third and fourth points to consider were outlook and valuation, and they go hand in hand. I think the outlook for ESG investments took a step up with the change in administration and Senate leadership, if you want to call what comes out of DC as leadership. Some would argue that it's worthy of a valuation premium, which we are seeing. I'm looking at the 2022 midterms and wondering if we need to trim expectations. However, I think the outlook is better for ESG, all else equal. Now, taking valuation into consideration, we don't see a huge premium compared to the broader markets. I said for a while that we think the broader market is close to high tide and not overly attractive, but we're not seeing anything concerning when looking directly at ESG or impact. When we look at our impact models within our own 9 Points Investment Management, we see slightly higher valuations there than the broader indices and our other non-ESG or impact models. I think it's a function of slightly better outlooks and flows. I think they could continue to trade at a premium for a while. As I said, right now, don't think that premium is too significant to worry about. We're watching the sustainable passive flows and the relative valuations compared to history and the broader market. The passive sustainable segment took in 70% of the flows in Q1, and that's pretty accurate for 2020 as well. I think that could be the canary in the coal mine. Not that ESG investors want anything to do with coal, or maybe they do if it's improving. But if we continue to see the outsized flows to passive coupled with an increase in relative valuations, we'll be the first to tell everyone about it here.
Thank you, Cliff, for your comments today. I think we really discussed a lot of important topics, and thank you to everyone who joined us. We hope this market lens lets you see 2020, and we hope to see you soon. Have a great day.